Our next guest is here to talk about why we might not be seeing a bigger impact than expected for some of these groups. Paul Donovan is chief economist at UBS Global Wealth Management, and he says there is some extra spending power going into 2024. Paul, welcome, because you don't think inflation is biting quite the way the CPI might be indicating. So really, there's a couple things going on here. Steve's talking about why aren't high rates having a bigger impact. You're talking about why isn't measured CPI maybe having as big of an impact. What do you see going on here?
So the thing is, in the United States, 1/4 of the inflation basket is a price called owner's equivalent rent. And it's a complete fantasy price. It's a price nobody pays. It's an attempt to measure the price of owning your own home. And at the moment, it's running at just over 7% a year inflation. But nobody actually pays this price. If you are a homeowner in the United States, you either have no mortgage, so zero year-over-year inflation, or you're one of the 95% of mortgage holders who've locked in your mortgage at a fixed rate, so no inflation. So this fantasy price is pushing up CPI, and the reality for the middle-income family that owns their own home in the United States is their personal inflation is substantially lower. So we're talking about inflation on average in the United States of about 2% for middle-income homeowners. And in some parts of the United States, cities like Chicago, for example, you're talking about homeowners having an inflation rate of less than 1%.
Wow.
That's giving you an awful lot of spending firepower.
Interesting.
And go ahead, Steve.
Well, I'm a little bit betwixt and between because I feel like I need to explain why we use owner's equivalent rent. And I'm brought back to the nightmare 4-hour conference I sat through where they debated this issue of whether or not to include actual housing prices or owner's equivalent rent. And what I will tell you, maybe to make the long story short, it's an effort not to include asset prices in the CPI.
Right. You can't put the price of a house.
They don't want to put the price of a house because they don't want policy reacting to the actual price. Now, there are people out there who argue...
Here's a question for you. Why can't they just... They're trying to impute what it would cost to rent your own home. Why can't they just survey people and say, what's your mortgage payment? Why can't they just do that and then just use that in the CPI?
I mean, I guess they could. Paul, did you say 39% of Americans are sitting with fixed costs, which is very close to the 40% of our group that's not affected by higher interest rates? Is that what you had said?
Well, if you look at homeowners, it's around 2/3 of American households actually own their own home. And of course, you're talking there about people who've either got no mortgage at all, in which case the mortgage cost example would be zero, or people who are paying this fixed rate mortgage. Now, over here in the United Kingdom, we do things differently, and we have variable rate mortgages, and so that makes a difference to us. Interest rates going up is a big problem in the UK, but you guys over in the States, you're living the easy life.
And I had seen, Paul, I had seen something about the average mortgage rate being 3.5% to 4% of those who have mortgages. So this gets at a really important issue, and I don't know if Paul wants to talk about this, but it's the effectiveness of monetary policy, and it really gets at this lag question, which is bedeviling the Federal Reserve right now. It speaks to the idea that the lags are, in this case, infinitely longer than they are in the UK or Canada, right, Paul?
Well, exactly. The US is a less interest rate sensitive economy than is the UK or indeed Canada, because fewer people are exposed to the random decisions of Fed Chair Powell, which, is very good for those American citizens who are immune. But it does mean that Fed policy is a blunter tool than Governor Bailey at the Bank of England is wielding over in the UK. Most people in the UK know who Governor Bailey is because he affects their day-to-day life. Literally, fewer than half the American population know who Fed Chair Powell is.
The trouble with this argument, Paul, I'm trying to lead it down different paths here. On the one hand, it suggests to me that the Fed ought to throw this out and really doesn't need to be quite as high right now. That's one conclusion.
Wouldn't it argue that they need to be higher because they're not affecting, like you said, the day-to-day kind of mortgage
Not
rate?
if inflation is lower. And those were the two paths that I was going down. Paul, do you want to solve that conundrum right there? What's the right policy reaction to this data?
So I think that the right reaction is to look at what's actually going on in inflation in the United States for many, many people, and to recognize that actually the US doesn't have an inflation problem. You can argue it's got a bit of a Florida problem. So inflation in Florida is actually quite high. Inflation in most of the rest of the country isn't. You've got a lot of regional divergence there. And also the fact that, when you strip out the owner's equivalent rent, when you look at the underlying, you can look at, for example, the harmonized consumer price inflation figure that is published by the states. That's a rough indication of what's going on.